Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with Annabelle Droulers.
Our top story is Japan leads losses in Asian stocks over worries of further rate hikes, with the hawkish Shigeru Ishiba set to become the next prime minister. Chinese assets, including property stocks, in focus as major cities ease rules for home buyers, following through on the central government's stimulus push. And Israel bombs Houthi targets in Yemen, ratcheting up its challenge to Iran following the killing of Hezbollah leader Hassan Nasrallah.
Happy Monday. Welcome to the eve of this Golden Week holiday in China, and certainly the last day of trading for many of those traders out in the mainland. So we're watching to see whether this rally can continue. And we got certainly some new news over the weekend when it comes to major Chinese cities like Guangzhou, Shenzhen, and Shanghai, removing some more of those restrictions there. So certainly that could be another leg up for equities here today. But in the meantime, the backdrop is looking a little bit more dire. You got to blame Japan for that, given that we see that yen surge. It has been waning a little bit now, but take a look at how the Nikkei is doing. We're seeing a slump of close to 4.5% on the Nikkei 225 after Shigeru Ishiba's surprise win to be the next Prime Minister of Japan. He supports, of course, the BOJ's normalization path. That's why you're seeing the stock slump, the yen surge more than 1% today. But take a look at when it comes to the rest of the markets. We're watching very closely when it comes to U.S. futures. We're flat, obviously, but we were able to cap another weekly gain for U.S. markets last week as well. We have, of course, the jobs report to contend with on Friday. But oil markets are a little bit elevated here today, just given the elevation of tension in the Middle East, right? So we're waiting for some sort of response to Israel's killing of the Hezbollah chief. Take a look at industrial metals. We're surging in Singapore. We're at 111, 110 for iron ore futures here this morning on the back of that easing of and more stimulus when it comes to the property sector as well. So ore is at 2-month highs, surging the most we've seen since May of 2023 or so. Dalian futures are basically up some 10% here right now, and the Aussie miners are certainly feeling it. You take a look at what the take from Bank of America is. They're basically saying the stimulus blitz could drive a broad rotation into stocks outside the U.S., into EM, into commodities. They say that is still going to be the best rotation breadth plays as long as that Chinese 10-year yield keeps that floor of 2%. We're starting to see that, right? Flip the boards and look at where those melt up in yields are going. We're seeing CGB yields are up some 4 basis points here right now. We're back to around 222 levels for your Chinese 10-year yield. Futures are still punching pretty punchy here this morning. And yes, dollar China 697, still looking pretty strong after the week that we had, right? The best week since 2008, 16% gains in the CSI 300, 8 shares, the best weekly surge, Bell, in nearly 13 years.
And it looks like the party might continue. Perhaps that's what we're seeing in futures. It definitely seems like these measures we got to assist the property sector are having big impacts this morning in trading. So something, of course, we're going to be watching very closely as we head through the session. Again, just mentioning those proxies like iron ore, the Aussie miners, the Aussie dollar, all of these are gaining here. Lots on the agenda. Of course, this is the eve, as we mentioned, of the Golden Week holiday. So in focus today, we've got those PMI readings. We've also got the unofficial gauges due. To note, though, this is for the September survey, so it's not going to really capture any of that bullish sentiment that we've got post the stimulus measures being announced, but still one to track in this hour. Yuan strength, of course, we've got the fix perhaps coming in the next 10 minutes or so. Property stocks really key here. Again, it's that story around these measures we saw, and just something that could add a little bit to the volatility. Actually, we had some transaction problems at the Shanghai exchange at the end of last week. Wrong-footed, perhaps a couple of hedge funds. We know they've been running some stress tests over the weekend. Question, of course, is it all okay for trading as we get underway today?
Yeah, is this market just so much of a FOMO rally that it's become too hot to handle right now? Certainly looks like to be the case. We'll see what happens after this Golden Week holiday. That's still going to be a big one as well. But we had also heard from the Premier, Li Qiang, promising to speed up the delivery of new policies and major projects to meet their annual economic goals. He spoke at a state council meeting after a barrage of stimulus measures were revealed last week. Let's get to our news desk editor, Jill Deesa. She joins us now. So it seems like this is an all-in on China here right now. We got more housing policies that came through over the weekend. What more can we expect now?
Yeah, well, I really think some of those housing policies kind of represented one of those last big walls toward easing significant measures within the property sector, right? I mean, Guangzhou removing all restrictions. That's one of the big tier 1 cities that we've been looking out for, whether or not they're going to actually make it easier to buy homes. That's what was just announced. We also got, as you mentioned, some additional easing in Shanghai and Shenzhen, so the other tier 1s. So, I mean, all of that kind of combined with, the government announcing, they were lowering borrowing costs on some $5.3 trillion worth of mortgages last week. We had the Politburo, the nation's top leaders coming out and kind of paving the way for a lot of this to happen by saying that they needed to address some of these really, really deep issues within, the real estate sector. That all combined with all of these interest rate cuts that we've been getting out of the central bank, various other easing measures, really kind of shows you here that there was this really massive show of force that the government wanted to make right before we headed into this Golden Week holiday. I'm sure at this point, probably going to be more to come. The way these things kind of work is that, the Politburo makes this big directive, and then you spend the next few weeks seeing all of these different agencies actually come out and announcing however they're going to support some of these policies. So we'll have to see whether that kind of leads into some additional momentum where we maybe see some additional easing.
Yeah, a lot of people have been talking about the fiscal policy response and whether that's really fully been detailed. So what could we really expect on that front, do you think?
Yeah, there's still, I'm sure there's still a lot more that the government can ultimately do because, yes, I mean, last week the big show of force here was on the monetary policy side mainly. What we've had in the past are, I'm not sure that we're going to see anything as dramatic as, say, last year where they made a big mid-year budget revision to try to, boost some fiscal support for the economy. We have seen some various measures in the forms of cash handouts for the nation's poor. I thought that was a bit of an unusual, bold move to make at the end of last week. Will we actually get any more? So now we're kind of entering this period where we do have this Golden Week holiday where maybe it's that the government wants to see, how much travel and spending picks up, particularly on a per capita measure, see if there's anything on the demand side that there really, really continues to be a pain point after the holiday. Maybe after that point, you see the financial ministry come out and make additional announcements.
All right, Jill, that was Jill Desis there, our news desk editor. Let's get more on this now, bring in Si Fu, a China portfolio strategist at Goldman Sachs. And I want to pick up on that point Jill was just making here, that policymakers are really having a concerted effort to show that force as we head into the Golden Week holiday. But what's your take on the stimulus measures announced so far? And is this time different to what we've seen in the past?
Yeah. If we look at all the policies announced over the past week, definitely it's unusually strong. Especially we haven't seen such collaborative and aggressive policy easing, basically touching all the major important aspects from monetary to fiscal, from the property market to equity market. And also it's almost the first time of the past year that we've seen directly measures touching on equity market. That is, they provide $500 billion swap facilities to financial institutions to invest in the equity market and $300 billion to corporates. They can use the capital to do buybacks. These are directly funding support to the equity market. So all these measures are welcomed by the investors. So if we look at the market response, which is also unusually strong, last week, if we look at our primary service trading desk, we saw the largest weekly hedge fund inflows in our record. So it is definitely a strong response to all the policies. And besides that, the long onlys are also adding position. For the onshore market, the turnover goes back to over 1 trillion level. So it seems all the different types of investors are getting engaged in this round of policy support.
What's going to convince global investors that this is something that is sustainable? What are they watching the most? Is it still domestic flows? Is it still signs in the property market? What's most important to them?
Yeah, so far what we see is we definitely know it's a trading opportunity open to investors. So that's why in terms of flows, hedge fund investors are the key participant right now. If we look at the flow composition, definitely hedge fund is the largest contributor. They can move pretty fast. So a key question is whether the rally could be sustainable. Our answer is we still need to watch for policy delivery and whether it will bring fundamental improvements from earnings from macro data. So far, what we see is from the policy perspective, people are waiting to see monetary and fiscal policy, and we are getting some hint on that direction. Especially over the weekend, we see the State Council meeting that is also going to that direction. This we think will encourage investors to position more. But after the National Day holidays, first thing we need to watch is whether other ministries will follow up with more details. The other thing is looking into long term, whether we will see some fundamental improvement. That will be important.
How are you thinking about the Golden Week holiday? Because it sort of, I'm wondering, do you think it sort of slows down the momentum where international traders, to Yvonne's point, have that sort of time now to sort of step back, think about what they've seen so far, what more they want to see? Do you come back and continue at that same pace, or is there sort of a recalibration around where Chinese stocks go from here?
Yeah, holidays could be interruptive if, according to historical experience, that give people some time to cool down, to think about whether this is the right trade. But this time it could be a little bit different because over the weekend we continue to see the State Council meeting that is suggesting we are going to fasten the policy implementation. So that's why we are seeing more investors are looking forward for more policies, more discussions to come after the National Day holidays. So that will keep investors engaged for a little bit longer. That's our expectation.
How do you see this rally evolving, right? It used to be just defensive, right? Just stick to the SOE plays. That's the safest part of this market. We're seeing signs of that spreading, right, to property, to consumption, for example. Yeah. Is now the time to be rotating to those names? And can we actually see more than just a China story, but also a global risk rally as well?
Yeah. We still think the companies with high dividend yield or stable shareholder return will continue benefiting from the recent policies, especially if we look at funding provided to the corporates, they can use that to do buybacks. So that will continue benefiting this shareholder return strategy. But besides that, over the past week, we also see, as you mentioned, property and consumer sectors rally the most, especially about consumer sectors. Staples rallied. The reason behind it is many people feel valuation is low in that sector. Given the recent policies, many investors will still buy the safe names or value names. So that's why staples were favored. And also people are having some hope that all the policies will finally turn the consumer confidence a little bit. So that will benefit the consumer staple sector. For the durable sectors, it also benefits from the trading program. So far, the progress is on track. So that gives investors more confidence to buy like furnitures, home appliance names that will continue benefiting from more fiscal stimulus. So that's why consumer sectors is definitely another focus now.
And do you see that actually meaningfully changing? What are sort of the things that you're looking at most closely in this? For instance, mortgage refinancing, does that allow people to sort of change their consumption appetite? If they've got those interest savings they can pocket and then redeploy, what's going to drive that the most, do you think? Or is it more fiscal measures, for instance, that are targeted?
We think it should be a combined result. So property policies is definitely helpful to boost consumer confidence because property is definitely an important part of household wealth. So after the property price stabilizes, definitely it will give investors consumers more confidence to really buy more goods or travel more. But besides that, we also think fiscal policies are also important because if we can boost employment, we can boost the income through different kind of policy stimulus, that will also be helpful for consumer space.
Two things: how much more upside, and also you still think H shares over A. Why?
Yeah. In terms of valuation, over the past week, after we have a more than 15% rally, that brings MSCI China valuation back to our fair PE forecast from a very depressed level. But that is the forecast we made before all the policy announced.
Yeah.
So with all the policies, definitely we are expecting it will continue lowering the equity risk premium that could give more room for valuation to re-rate. And also, if we could expect more fundamental improvement, that will give even more room. Why we are favoring H over A right now is still we believe fundamental matters. So if we look at earnings delivery, internet sectors listed offshore is still the brightest spots with robust earnings delivery. But for A shares, over the past 2 quarters, we only achieved around 0% earnings growth. For the full year, we focus 6%, which is also a little bit lower than offshore. We focus 8%. So earnings is the key challenge there for onshore stocks.
All right, Si Fu, we're going to leave it there. Thank you so much.
Thank
Our
you.
China portfolio strategist at Goldman Sachs. And here's what else we're watching out for this week as well. We're taking a look at when it comes to this Asia week ahead. And certainly, it's going to be a bit quiet given the Golden Week holiday. But of course, we'll watch very closely any indications of how activity is going to be. Are people going to be looking at the stimulus and thinking they're going to look at homes, buy property, head to the movie theaters, consumption patterns, the like here? Powell is also speaking this Monday as well, so watch out for any sorts of clues here. I think still that PCE inflation report on Friday did show signs that it is still a cooling economy, although they did see prices tick up just a little bit higher. But that's not really the key focus of the market now. It's going to be that U.S. jobs report that is happening on this Friday as well, Belle.
Yeah, that's right. And just to note there, the Yuan reference rate at the bottom of your screen, pretty much in line with estimates, but still ahead. That focus very much on this stimulus bonanza. Traders are going to be watching whether the push can energize consumer spending across China as the nation heads into that Golden Week holiday. We'll get a preview later this hour with Bloomberg Intelligence. And counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. Futures telling us that property story is really going to be playing out. Vanke shares, for instance, indicated to pop 15% at the start of trade in less than 15 minutes from now.
On October 1st, with the election weeks away, the VP candidates are set to face off.
When we fight, you guys are going to get me all fired up again.
Trust Bloomberg for news and analysis.
So is it style or substance, or maybe both? We'll be hearing from Tim Walz and J.D. Vance in prime time.
Yeah, and the question is whether the vice presidential nominees are actually able to move the needle.
Tune in for the CBS News Vice Presidential Debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
Well, Israel's launched airstrikes on Houthi targets in Yemen, ramping up its challenge to Iran following the killing of Hezbollah leader Hassan Nasrallah in southern Beirut. Our Bloomberg managing editor for Weekend News in the Americas, John Edwards, has been following the story for us out of New York. And John, Benjamin Netanyahu is saying that they've knocked out Iran's main engines or their axis of evil. Is that accurate, do you think? Where do we stand after these huge events really over the weekend?
Yeah, well, it is really a major advance for Israel's effort to beat back Hezbollah in Lebanon and to sort of try to stem some of the attacks that Hezbollah has been launching into Israel's north. The killing of Nasrallah, along with several other major Hezbollah commanders, is a major blow to that Iranian proxy, and it does really signal something of a shift in the balance of power in the region. What we're seeing so far is that Iran is, for the moment at least, holding back and content to let Hezbollah respond to the extent it's able to. But Hezbollah's capabilities have been severely diminished by the relentless attack from Israel, and it remains to be seen how much and in what way Hezbollah will be able to respond at this point.
Yeah, it seems to have, certainly paralyzed Hezbollah in a big way. Tell us a bit more about what the Iranian response might be, and is there really now a risk of a full-blown war in Lebanon?
Yeah, there is certainly some risk, and tensions are obviously high. But Iran has seen, when it launched direct attacks itself against Israel in April, Israel's defenses were able to stem almost all of those missiles, and then it sees that its main proxy in Hezbollah is severely again degraded, as is Hamas, of course, in Gaza. And so, I think Iran is really going to be assessing, at least for the next few days, what its remaining capabilities are and what its real posture is in the region, even as Hezbollah itself tries to figure out what it might be able to do given the loss of so much of its leadership and so much of its military material.
John, Great to have you, John Edwards, there, our Bloomberg managing editor for Weekend News in the Americas, joining us out of New York. And you are seeing oil markets slightly bid up here this morning. Your pre-market in China and Hong Kong looking like this. There you go. It's Monday morning. Good times ahead. 2.6% for your Hang Seng. 8 shares are on a 12 straight gain here when it comes to what we're seeing. The pre-market futures are punching 1.5%. This is Bloomberg.
We're coming off a week of superlatives, but it looks like the party extends for another session today. We've got futures for the open in Hong Kong pointing to a very strong start to the day here. Look at that Hang Seng Tech Index, for instance, up 4.4%. But it seems like, yeah, you had those monetary policy announcements. There were the hints or the ideas we're going to get fiscal measures, and that has really reassured investors.
Yeah, this morning it's all about the property and easing that we're seeing in some of these tier 1 cities. That certainly is helping that trade here this morning. And yes, it's ahead of that PMI data that we're getting. Yeah, I don't even think people are going to look at this, really, Belle, because it's going to show why we are seeing this massive coordination of fiscal and monetary policies here, right? So things are still going to slow down. Manufacturing set for a 5th month of contraction there. Easing, looking a little bit better, but BE says it's really due to seasonality. Non-manufacturing still talking about 50.4 point as well, but certainly that is not going to be a huge concern for the market here, just given it's all about the stimulus and this isn't the whatever it takes moment for China. In terms of your analyst actions here today, Hang Lung Properties getting an upgrade from Jefferies. They say, look, recent stimulus from China and expectations on consumption-led fiscal measures is going to boost the outlook for Hong Kong landlords with China retail exposure. So they're talking about Hang Lung, they're talking about Swire, Meituan as well. Good call from Citi here when it comes to JD.com as well. So they're lifting both the price targets for those stocks, improving consumer demand for their products and services after, of course, those stimulus measures. So all kind of stimulus related here today as well in terms of stocks to watch. It's the property sector, it's the steel makers, it's everything related to how this housing market is going to react to the stimulus measures, with Guangzhou becoming the first tier 1 city to remove all restrictions. Shanghai, Shenzhen followed, allowing more people to purchase homes in suburban areas. Take a look at Wangke. We're up close to 15% in the pre-market. Steel makers, iron ore is surging in Singapore. NEO as well, getting a capital injection, close to $2 billion from its parent and investors as well. That's getting a lift here today. And we're watching very closely these consumption stocks, seeing a pretty good day today as well. You're watching the China Show. Happy Monday, 45 seconds into this open, and it looks like we are on our way to being more of this catch-up story when it comes to Hong Kong. And really, when you take a look at how 8 shares are concerned, we're talking about 12 straight days now that we could be seeing gains on that benchmark. And it could very well be one of the best markets to really outperform in 2024. Can this actually last is still a big question. But yes, the last day before Golden Week holidays, and people are still looking pretty upbeat as well.
Yes, that big question. It's indeed the question of the day being put forward by a Markets Live team. How do Chinese stocks do after the break? But actually, it was what we put forward to Goldman Sachs earlier, and they were saying there's enough policy already being implemented or directed to tell us that there is still legs for it to extend. And even when you take a look at what we're seeing in HF futures, we're a long way off trading looking overextended in terms of bullish positioning. This is the start of the day here, though, that we see for the mainland China market. As we said, we're really on the eve here of the Golden Week holiday. Question marks around how consumption fares during this period. It's a key period as well for buying property. Do those easing of major home buying curbs or rules over the weekend, Guangzhou, Shanghai, Shenzhen, really start to pay dividends and people come back in, find that stabilization in the price market. The CSI 300, that is a very, very strong start to the day, up 4.4%. But here we're heading for a bull market territory. Some of the names we're tracking in particular, again, it comes back to that consumption story, because when you have that mortgage refinancing, for instance, it leads to more interest savings. Does that benefit consumption appetite? You are seeing Kweicha Motai, really a barometer of consumer sentiment, up 4.2%. So that's the start of play here for mainland China markets. Let's change on, take a look what's happening in Hong Kong as well, because it's that read-through trending across. You've got the Hang Seng 2.7% to the upside. Hang Seng Tech, look at those gains there, 5% in the green here. Alibaba, for instance, near 6% higher, Tencent gaining, Meituan at 5.7%. I mean, really, there's so much, again, optimism, the question how long that extends for, but certainly at least as we approach the National Day holiday.
Yep, today it is still stocks over bonds here today. We talk about that melt up in yields in CGB markets here, and we're certainly seeing on the long end here this morning as well. Yeah, and there's a lot of goes on, but we're looking at the PMI numbers for September, if you actually care. I'm going to mention them very quickly. 49.8, so still better than expected, but we're still confirming that fifth month of contraction for the factory floors. We'll see the breakdown, right? Because the last print, it was mostly about services offsetting construction. It might be the other way around this time around, according to Bloomberg Economics. Non-manufacturing is solid at 50, but this was a miss. So that could be also a concern why we are seeing a non-manufacturing PMI that is slowing down, still in expansion, but just on the fence here right now. Yes, the market's really moving ahead of this. This is just really data for at this point right now. But you take a look at how these movers are doing. It's really about the home easing measures that we're seeing across these first-tier cities. So take a look at property stocks, for example. They continue to have a field day today. Wonka's up some 18%. Gemdale's up close to 20% gains here right now. And we're watching, of course, steel makers, just given what we're seeing, the surge in iron ore, and what we're seeing here on the back of these stimulus measures as well. So Angan Steel, Bao Steel, all doing very, very well here today. Consumption plays, obviously, just given what we've been seeing as well. Ahead of the Golden Week holiday, there seems to be a change in sentiment, right? I think there was one social media post we were tracking. It was like, I think it was like a week ago. I was like, I might just stay at home, Belle. and then the monetary policy stimulus came through. They're like, maybe I'll go to like Sanya. And then you talk about, after we got the fiscal stimulus, it's like, I'm going to Europe.
Well, that's it. And now we're
Forget
talking about
domestic travel. I'm
long
out.
range. Absolutely. Yeah, people are going to some far-flung places. Macau casinos as well. I mean, Citibank, for instance, is saying that the Golden Week booking is looking strong. So again, you're seeing those changes coming through in Macau casino stocks in turn, a surge of up to 7% for some of those names there. But let's get more on that now and bring in our Bloomberg Intelligence APAC hospitality analyst, Angela Hanley, joining us this morning. And Angela, it seems like the expectations for Golden Week is that we could see some pretty solid numbers coming through.
Yeah, suddenly everything just got flat. And then I don't know, whether this kind of positive sentiment can last until they can be reflected into October Golden Week numbers.
Yeah.
I just say, sentiment is good, but people have already planned for their long weekends already. So I'm not sure, maybe they already plan to go to some nearby places, because the data shows that 80% of the domestic trips booked are actually by cars. They still prefer going by cars to nearby places, although it's cross-provincial, but still remains like a shorter distance. Because we also see that room rates of hotels in China and also some flights looks cheaper than last year. So that means that still the demand for traveling is there, but it remains for places which are a bit nearer. So maybe we feel although consumption vouchers, the sentiment is improving, but usually the consumption has been kind of lagging segment in the economy. So say, firstly, in China, the manufacturing has been very important. So we have to see these parts to improve to show that people can spend money on consumptions. So I think generally, I think our team believes that, consumption can maybe sentiment is better, but still to be reflected into data, we need some time.
I think we had Goldman Sachs on last week said if you look at the parts of consumption that is still looking pretty strong, travel is still the key beneficiary. Is that going to be likely the case for the rest of the year, you think?
Yeah.
What other parts of the consumption story do you think could still benefit?
So I think regarding the October Golden Week, maybe traveling is something they already planned.
Yeah.
So we are not going to see a big difference.
Sure.
But at least in travel segment, the ones can have better benefit could be something like Trip.com, which is more like online travel agencies. Because these are the ones which could benefit when people want to go to like small cities or villages.
Yeah.
If you talk about like hotel chains, they are usually mainly in like big cities. So we see that, like, given that the sentiment is more these like cheaper places, like a value for money, then it means that like hotels might benefit less than like online travel agencies. But if we talk about like because of sentiments, like cash vouchers, then people might spend a bit more because of sentiment. Then that could be reflected into maybe catering sales because they may want to go to upgrade a bit. Like maybe if they went for steak, they will want to get a Wagyu steak maybe. So I think it's more like a slight upgrades in their like a menu selections, I guess.
Yeah.
So you actually do expect to see perhaps a slightly higher spend per person, because I think that was sort of one of the key things we saw over the Lunar New Year break, that we actually had more people traveling, but their average spend was down.
Yes. So it was improving a bit. So like if you remember like days ago when it was Mid-Autumn Festival, like when we get mooncakes. In that day, the one impressive number was like per traveler spending in China was actually above 19th level. It was like the first time since like after pandemic. So that means that people maybe on per capita basis still want to spend, mainly because of the travelers from smaller cities in like rural areas. So I think that trend could be extending into October Golden Week, meaning that maybe per traveler consumption could be still better than like a 19th level.
All right, Angela. Thank you. Angela Hanley there, Bloomberg Intelligence Analyst on Asia-Pacific Gaming and Hospitality Research. Take a look at when it comes to these markets. Yeah, it's still looking like a pretty bullish day here right now. I love that quote from Huang from Grow Investment. It's not even the time to talk about whether this is technical or something structural. This is a very easily tradable market here right now that you should be riding on. Right now, 6.3% for your CSI 300. And you take a look at when it comes to Hong Kong, 3% gains for H shares as well as your HSI. HS Tech is driving that. We're up some 5% for some of your growth shares here this morning. We got plenty more ahead. This is Bloomberg. All right, a bull market in play. That certainly is the big question here today. Take a look at how the CSI 300 is doing. It is soaring here right now. We rarely see moves this large in the onshore market. In fact, this is one of the biggest we've seen since 2015. So certainly it's more about the A-share market than H-share, but certainly it's more of a catch-up story because Hong Kong was doing very well compared to the A-share market last week. But still, Hang Seng still punching above 2.5% here this morning, Bill.
Yeah, let's get more on really what's driving this stock market rally and bring in Robin Xing. He's Chief China Economist at Morgan Stanley. And Robin, we want to get to you on really a question that a lot of people have been asking in the measures that have been announced so far and what's sort of been signaled to come. Do you think that this is a whatever it takes moment for the Chinese economy?
Well, I think the pivot is big. It marked a significant change in Beijing's mindset to fight deflation. So this is the first concerted effort to fight deflation. However, it may not be the whatever it takes moment yet. For that whatever it takes moment, I think we need to monitor the perceived social risks. And we built something called the China Social Dynamic Indicator. It is approaching the trough level we witnessed, say, in late 2022 when China reopened from COVID, or in late 2015 when China did a massive stimulus on its housing sector. We are approaching there, but not there yet. So I do think this is the start of something, but for something like $1 trillion decisive stimulus, we are not there yet.
What's missing, Robin?
Fiscal action. So they did concerted efforts on stock market, on monetary easing, but we need a central government to expand its balance sheet, because a lot of investors will compare today to November 2022, the big pivot towards reopening.
Yeah.
The mindset change is very similar. However, the approach will be different because reopening from COVID is a 1-2 punch. You just allow people to move, they will move. But today, from persistent deflation to reflation, you allow people to buy a house to spend. They may not spend.
Yeah.
You need the central government to boost consumption to provide social welfare. We are waiting for that.
We're going to show the social dynamics indicator that you just mentioned, right? So you talked about we're getting close, but not quite there to those policy pivots that we saw back during COVID, back during, I believe, 2016 timeframes as well. How serious do you think, though, this time around is China about tackling some of these structural issues?
I think it's very serious. Basically, if you look at the indicator, it's based on things like unemployment, on wage, on social benefits, on labor incidents. So I think this is because right now China is feeling the heat of deflation. Revenues are down, local governments are struggling, jobs are on the line. So it's a wake-up call. That's why they made this pivot towards reflation. However, reflation is a long, bumpy journey.
Yeah.
They have to do probably a lot of a trial and error approach because they have to shift from supply, infrastructure stimulus, to demand on consumption, on social benefits. These approaches are new for China. They were not familiar with this approach. So I don't think they can upsize this stimulus to, say, $1 trillion next month. They will probably start with smaller actions, 1 to 2 trillion RMB. If it failed, they will continue to upsize.
The rally we're seeing, though, is sort of predicated on the sense that we are going to get fiscal policies being spelled out. If we're not quite at that inflection point in terms of social instability, do they meet the mark and investors' expectations on that front, do you think?
I think I would watch for the late October. There is a standing committee meeting of MPC, and they could use that to widen the budget deficit. So providing supplement deficit of another 2 trillion RMB for consumption, for social benefits. And if they do that, despite it's still not enough to completely break deflation, that may help near-term growth. Sequential GDP growth may improve slightly in fourth quarter this year to earlier next year. So at least in short term, we see them doing a lot of things to try to provide a floor, as you can also see from today's PMI reading. But for sustainable reflation, we need that bazooka. We are not there yet, but once that social dynamics indicator slip further, I do think Beijing will have no choice but to do something bigger and faster.
The easing measures we're seeing from the property market. So first-tier cities now are removing almost all their restrictions. Guangzhou is the first. You add that to the mortgage refinancing, the mortgage rates being cut. What's the intention from policymakers here? Is it really just to establish the floor for the property market to bottom, or do you think it's more about reversing some of the losses we've seen in the past few years?
They want to reverse it. So they said it in the Policy Bureau meeting 3 days ago. They want to reverse the trend of decline in housing market. However, reversing by just cutting rates, by just cutting down payment is not enough because deflation has been so persistent. If we want to change people's mindset, central government need to step in. For example, can central government purchase some unsold units from the market, converting to public housing to reduce this inventory overhang? They are not there yet, but that's one of the bazooka options they have if the perceived social risk will be large enough to trigger that.
These measures to try and stimulate economic growth are sort of more cyclical in nature, some of them, it seems. If you have that, do you end up adding to the more structural problems, though? Because these measures that were announced to try and overcome the amount of debt in the property space and the sort of leverage that property developers had led to the problems in the first place. If you're removing those home buying restrictions, do you not add to that original problem as well?
Well, every single country who had property market up and down, they had this once in a lifetime bubble burst. China has it, but in the US, Japan, Finland, Ireland, they all had it. The difference is eventually after the bubble is burst, after the downfall, how you try to provide a floor, try to shorten this painful adjustment. In China's case, volume has declined by 70%. That's even more than any other country who had that deep adjustment for the housing market. So now is the time we probably see overshooting in China's housing adjustment. That's why the central bank, the central government can step in to provide a confidence boost. So I don't think it's going to have that problems of misallocation, bubble risk again, no. But having said that, the reason we think they will start with modest fiscal support in social benefits, in consumption goods, is also because they want to say goodbye to the old approach, massive infrastructure or industrial stimulus. That's going to create more problems down the road. So they try to shift the mix to demand, to consumption. But because these are new moves, honestly speaking, we need to be patient. You may see 2 trillion RMB down the road in next 2-3 months, but not that $1 to $2 trillion decisive bazooka moment yet.
Is that why we're not seeing economists like yourself quickly upgrading their forecast for growth? I mean, is 5% this year achievable now, given what we've seen so far? And what does 2025 look like to you?
I would say it's definitely seeing more balanced risk. I mean, the government target in the last 3 months, given how the deflation has deepened, everyone has been cutting growth forecasts. It's like a downward spiral if they keep hesitant on doing anything. In another 3 or 6 months, the street may cut growth forecast again. But now the risk is much more balanced. In fact, in Q4 this year and earlier next year, we see some modest improvement in sequential growth. That's not a sustainable long-term reflation yet, but I think this is the beginning of more concerted attempt to reflate.
We've spent so much of this year concerned about balance sheet recession. Do you think that that risk has evaporated now for investors?
Well, the risk is still here, right? I won't say just by cutting rates, injecting liquidity for the stock market. I mean, Japan did that in 2010. They have their central bank buying ETFs from stock market. But eventually, how Japan reflated successfully is with more coordinated monetary and fiscal easing. So we are not there yet. We see the green shoot of something bigger. We are not there yet.
Given what we've been seeing across these markets, it seems like it's a very liquidity-driven rally. Does it stay something that just impacts financial markets, do you think? Or do you think they could actually spur up consumption and at least unleash people who have been really hesitant to spend?
Well, both stock market and the housing market have wealth effect for consumers. So stock market rally is definitely not a bad thing for consumption. However, housing market is bigger in China. So I would say if the central government decided, I would step in, providing a central budget to purchase unsold units to reduce the inventory. That would be even more powerful than the stock market measures.
Okay. All right, Robin, great to have you. Robin Xing there, Chief China Economist at Morgan Stanley. We have these Caixin numbers coming through here, too, ahead of the holidays. So September manufacturing PMI, this was also a miss, 49.3. The estimate was actually for something that was more of expansion of 50.5. So that is still another miss there. 50.3 for your Caixin services gauge, which is also a miss from the previous month, well, slowing down from the previous month as well. So, yeah, I mean, it basically confirms what we saw with the official numbers too, Belle, that things were looking pretty bad before we started to hear more from policymakers and finally them responding. Yeah, I mean, really underscores perhaps that need of why we've seen this aggressive stimulus announcements over the past week. But we'll have more ahead on the China show. This is Bloomberg. Welcome back to the China show. Here are some of the big stories we're tracking this morning. And Bloomberg has learned Beijing is ramping up measures on local firms to buy domestic AI chips instead of Nvidia products in a bid to expand its own semiconductor industry and counter US sanctions. Sources say the policy has taken the form of guidance rather than an outright ban to avoid escalating tensions and handicapping startups. Nvidia shares extended declines Friday after the Bloomberg report.
Bloomberg sources say the EU is planning to vote on Friday on whether to impose tariffs on Chinese-made EVs. Member states have received a draft of the regulation which could impose tariffs as high as 45%. Europe says China unfairly subsidises its EV industry, but Beijing denies unfair practices and has threatened retaliatory tariffs. Both sides are still discussing a negotiated solution.
All right, now let's check these markets here. And yeah, the animal spirits are out once again for another day. And take a look at what we're seeing here. And we're watching some of these kind of private companies. There was that line that we got over the weekend of China pledging full support for the private sector. So there you go. You have the likes of Meituan is up 2.5%. Citi also lifting the estimates of Meituan and JD.com, reflecting possible improving consumption demand when it comes to food delivery, local services, hotel, and travel bookings. So maybe we can start to see signs of a ramped up macro recovery, according to Alicia Yap and her team. That price target for Meituan, for example, has now been upgraded to 192 from 155 levels as well. In terms of what the dashboard and what China markets are looking like, it is another field day. You take a look at how mostly you're seeing green on the screen. The flip side is that CGBs are selling off in a pretty massive way. But look at your developers index. We're up another 9% here right now. CSI 300 on track of hitting a bull market if we continue with these gains, Belle.
There's something that's really just caught my eye, and I just had a look at the WVM function, which tracks trading volumes. Looking at the 20-day moving average for the Shanghai Stock Exchange right now, we are 300% higher than where we would typically be on a 20-day moving average basis. That just tells you there is a lot of momentum, a lot of trading volume in this activity, or this market rather, as we approach the Golden Week holiday. 300% higher than its typical where it would be on a 3-week basis.
Yeah, the hedgies or hedge funds are, fingers crossed I don't see any more glitches here today, but it seems like things are smooth sailing here right now. Global macro movers looking like this. We'll have more coming up. This is Bloomberg. Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session. If you take a look at a chart and broaden out for the last 2 weeks or so, I mean, this market has gone vertical. You take a look at how we're looking at. We're trading close to 4% gains on the CSI 300. We're already off some of the highs in the last 30 minutes of trade, but just goes to show these markets are heading into the holiday, the Golden Week, with a bang, and continues to be very, very upbeat this morning, Belle.
Yeah, I mean, let's look at it another way. You've got trading volumes as well that we can check in on, and the CSI 300 extremely elevated at this point in the session. You're talking about volumes that are around 370% higher than where they would be on a typical 3-week basis. So certainly another metric that just shows us traders are really buying in as we approach the Golden Week holiday. That's the question of the day. Will that momentum extend even after this upcoming vacation break? So this is what we're seeing here, as we said, trading volumes of the CSI 300 looking very, very elevated. Let's change on. What's driving it, of course, is this whole host of stimulus measures, but the one that's really catching a lot of people's attention this morning are these measures around easing home buying restrictions. So we saw this playing out over the weekend in Guangzhou, Shanghai, Shenzhen. We've also got the PBOC announcing refinancing of mortgages, so homeowners can renegotiate the terms with their current leaders effective November 1. Got more savings. Is that going to be deployed out into consumption stocks? But certainly property stocks, energy stocks or iron ore stocks, miners moving higher in the session today. Switching out, taking a look at a broader session here, because Asia ex-China today, actually the MXAP index rather, is under pressure. That's really the story of what's happening in Japan today. You take a look at the Nikkei 225, last half hour of trading activity before we approach the lunch break, but rising rather down 4.3%. We had the surprise nomination of Ishiba. He's set to be the next leader in Japan. He's someone who's associated with policy continuity. You've got that expectations of further further BOJ hikes to come. That plays into the exporters because it's, of course, moving the Japanese yen. You can see there around that 142 mark, but something that is really weighing on those export names this morning in the session. Broadly, though, as we approach, again, we were just noting that this is the last day of the third quarter for trading activity. We're heading into the fourth. It's that broader story around rate cuts that are going to come. Do we see really the stage when you combine rate cuts from central banks, China's stimulus measures? Are we setting the stage for a very positive fourth quarter?
Yeah, the Santa rally coming early, maybe. You take a look at how things are looking at and how people are positioning around China here right now. I think Goldman Sachs, the brokerage, did talk a little bit more about you're seeing that rotation out of U.S. tech into some of these sort of China-related sort of assets, right? Take a look at how materials are doing. Bank of America's Michael Hartnett saying, look, these are some of the best breath sort of plays here right now is the unloved commodities. And we're seeing that with iron ore. Take a look at that. It's a 7% surge in Singapore here this morning. Let's head to Singapore. That's where our MLAS strategist, Mark Cranfield, joins us for more on the market action. And Mark, I mean, it's just been a crazy few weeks or even just a few days for Chinese equities. We basically head into a bull market in a matter of just a week or so. Can this continue? I mean, we're going to be shut for close to a week in just a few days. What happens after?
Yeah, I think that's a lot of people will be asking is can this good mood continue? And there are certainly a few indicators which suggest that it's on pretty solid footing here. I know it's looking a bit ridiculous at the moment, and we're running out of superlatives for these crazy moves. And even the parabolic move in some of these indices is the kind of thing that some people will get a little bit scared of. But if you look at what's lying underneath, we seem to have met that watershed moment where the positives are falling into place. So as you were saying, more measures to help the property market in the big cities on top of all the things which came through last week. And it's only just, of course, beginning to feed in. People will be watching what consumers do during this holiday period. They'll be looking for very good numbers. People in a better mood to spend money in China because of what they're seeing in the stock market and the thoughts that the economy will start to get better as well. If you look at the relationship between iron ore, for example, with Chinese equities, it's a very positive, reinforcing environment. So if equities continue to go higher, you would expect iron ore to follow as well. People will think that the real economy is starting to see the benefits of all of this as well. If you want to look for one single indicator to tell you that things are changing positively for China, look at the CSI 300 index. When it peaked in early 2021, it went down and down and down all the way until this year. There were 7 occasions when it tried to break that sequence of falling indices. It didn't happen until the end of last week. Finally, on the 8th attempt, it has beaten one of the previous peak points that we saw in that downtrend and is accelerating again today. So that is the kind of thing that will capture the attention of a broader set of investors. People around the world will be waking up and seeing the China market is finally turning positive. And it's at such a low base that, as Stephen Jen was saying in his report on Friday, this could run a long way.
Mark, we see it with Chinese assets. I'm wondering how far does it go when it comes to sparking a global risk rally? You mentioned about commodities, iron ore that's surging here, the relationship with Chinese equities here right now. But how much more can this spread beyond just the China situation?
You won't find too many people that will want to fight against this. On the one hand, you've got the Federal Reserve in the United States have already done a very large interest rate cut, and they possibly will do so again. The PCE inflation data last week was pretty soft. It was down to the kind of levels where the Federal Reserve might even be thinking about doing another 50 basis points interest rate cut. We're going to hear from Jerome Powell this week, so we might get more of an idea. But certainly, if you look at the way the markets were trading in America and Europe, they certainly think that another big rate cut is on the way from the US. You add China stimulus to that, you've got the 2 biggest economies in the world really pushing hard to try and get their economies to do it. They weren't doing that badly. I mean, the United States especially, the economy was doing reasonably well anyway, even before the Federal Reserve started lowering interest rates. So that's going to just add fuel from that point of view. What China does will feed it back into Europe as well. It's one of their biggest markets in terms of exports. They'll be very happy to see what's happening there. It's really becoming a self-reinforcing cycle where everybody can join in. The one place where there could be a question mark is Japan. This new Japanese Prime Minister looks as though he's going to call an early election And that might be a little bit of uncertainty for investors there. So Japan may get left behind, but the rest of the world looks in pretty good shape.
Mark, that's exactly what I wanted to ask you about, this sort of surprise elevation of Ishiba in Japan. Takaichi is being priced out. Is this just a knee-jerk reaction that we're seeing, or do we actually need to get that policy continuity first until we find a footing?
Well, if you read some of the stuff that Bloomberg Opinion has been doing, very detailed analysis on Japan's new leader, suggesting that he's the anti-Abe. So that's not going to be great for Japanese equities. It may be very good in certain respects. He seems to support the Bank of Japan on raising interest rates further. That probably feeds into a stronger currency. But certainly from an overall investor point of view, it will make people a bit cautious, particularly foreigners. They may not want to put too much money into Japan until they see how his policies are going to develop, assuming, of course, that he calls an election and he wins it. If you look at the fact that we had 9 different people going into that leadership vote from a whole range of views about Japan, that's quite unusual. So it suggests that this election, if it comes, will be no means will be easy to tell who's going to win this. It could be quite a very close vote. So all of that adds to uncertainty in that picture. But overall, it probably emboldens the Bank of Japan to stick with their tightening policy. Good for the yen, maybe not so good for Japanese equities.
Yeah, and as we're seeing that the Nikkei 225 down 4.5%. But that was Bloomberg's MLive strategist, Mark Granfield there. Thanks very much for your insights. We're going to leave you now with some live pictures out of Beijing, where we're seeing pictures of the commemoration taking place on Martyrs' Day. This is marked on the eve of National Day in China to commemorate those who lost their lives serving China. So we've been seeing Xi Jinping leading this, along with senior officials and representatives paying tribute to the monument of the people's heroes at the Tiananmen Square to, as we said, commemorate those who lost their lives serving China. Some live pictures there from Beijing, President Xi in place leading those Martyrs' Day commemoration proceedings.
October 1st, with the election weeks away, the VP candidates are set to face off.
When we fight, you guys are going to get me all fired up again.
Trust Bloomberg for news and analysis.
So is it style or substance, or maybe both? We'll be hearing from Tim Walz and J.D. Vance in prime time.
Yeah, and the question is whether the vice presidential nominees are actually able to move the needle.
Tune in for the CBS News Vice Presidential Debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
All right, it might not, I mean, you don't even have to look at this really at this point. We're seeing with these PMI numbers that came through. It was a little bit of an improvement when it comes to the manufacturing side of things in September, but we're still talking about 49.8 print, so still in contraction for a 5th straight month as well. Non-manufacturing was also a slight miss as well. You look at the Caixin numbers, it was misses across the board. So I think the big takeaway from this really, Belle, is that now you see why. Why did we see this massive sort of stimulus bliss last week?
Yeah, exactly. I mean, it's a little bit in the rearview mirror because it's not going to be capturing any sort of that bullish sentiment arising from the stimulus announcements last week, but still something that we do need to keep an eye on as well. Let's bring in our team. Our Bloomberg economist, David Chu, is here, along with Bloomberg opinion columnist Shirley Wren in the studio. But Dave, I'll start with you. And yeah, I mean, we've had those PMI readings this morning. Is that how you're sort of looking at it? Weaker numbers really underscores that need we have for stimulus.
Yes, we have to say that if you look at the data, you will feel that the economy is still bad. But you know what happened in the last week, because the sentiment of the market had a U-turn, right? But still, if you look at the data, it raises a question. Well, people have been asking since last week. Many of my friends were asking me. Yes, we saw the boom in the equity market, and we saw the stimulus delivered. But what do you think about the real economy?
Yeah,
it's still in some question because you know, if you see the equity market, people are very confident, are very happy, and you know, excited. But if you look at the real economy, still the question is, and whether and to what extent the stimulus can help the economy.
Yeah. What do you make of it, Shuli? I mean, is this the whatever it takes moment that we're seeing from China now?
I perhaps wouldn't go so far, because if you look at the recent announcements, they're still doing the Chinese traditional medicine way, like increase the dosage a little bit and adjusting the dosage. But I think this time is a little bit different because the rhetoric has changed, right? Like you just feel like from the recent press releases, etc., that the government seems to be less out of touch and better informed, and they seem to have realized why past policies have not worked. For instance, economists have been talking about the second wave of shocks in China, in that local governments, which in the past served as major helping hand, are sitting idle this year. In fact, the fiscal strength is even less than 2022 or 2023's. So you see that in the Politburo readout, the first thing is fiscal stimulus, front and center. So I think the sentiment, the top seems to have figured out what's really ailing China, and that's a good first step.
David, do you agree with that? Because I think to your point, I mean, most Chinese are not holders of equities anyway. So even though you have that exuberance, it doesn't really impact the everyday person. Do you think, to Shuli's point, that these measures are more targeted, they could actually reach the everyday person? Will we see that?
Well, I don't think we don't have a clear definition on the everyday person. But I think, yes, starting from the equity market is a good way, because it costs less money for the government to boost the confidence, So if we have a start, the equity market could be a good choice. Another choice is to boost the housing market, but it would cost much more to boost the whole economy or via the housing market. So if you look at this, yes, maybe.
What do you look for next now, David? We just had Robin Xing from Morgan Stanley on saying, look for late October, this MPC Standing Committee meeting, where we might see some follow-up through when it comes to fiscal measures. Is that going to be the next sort of catalyst, you think?
Well, based on my past experience, I would have to say that, yes, we may see some fiscal stimulus on the way, but maybe it could be weaker than what people have been expecting over the past week. Because in the last week, we have seen several rumors or talks in the market about how the size of the fiscal stimulus, blah, blah. But based on my experience, I would say probably it would be smaller than expected.
Shuli, how does that stack up with what you're hearing? Because one of the things that has impressed you is the fiscal power of what we've had so far.
Yes. So people are hoping that at least there should be some kind of a fiscal reform, right? The central government has a lot more money, and the local government, the land sales, we know land sales revenue is gone. So there has to be some form of a fiscal reform. But going back to the equity market, I think like what David was saying, like it's a cost-effective way to stimulate the economy, because we all know local government is not doing anything, and the government needs to make private enterprises feel more bullish so that they can invest and hire tens of millions of fresh college graduates. And having a bullish stock market helps, right? Like if you are a chairman of a company and you say, oh, my stock is up, then I might actually have confidence in the economy and might invest again. So I do feel that this is a more cost-effective way to stimulate the economy.
What are your sources? What are people telling you right now, Shuli? Is this something, what we're seeing in the market, something that's just technical? Are they starting to look at re-rating and saying that, policymakers are really serious about these structural issues now in the economy?
I heard some very interesting comments. Some people have compared the last few days of change to China's abrupt exit of COVID-0. Yes. Let's remember that, right? Like they will say, oh, China, the Communist Party has a history of sharp U-turns. They will hit the wall and then they will turn around. So that's the bullish side. And on the other hand, some people are very cautious, right? Once bitten, twice shy. Like China has been stimulating the economy for 3 years. Property market cooler than ever. Youth unemployment at record high again. So there are two sides. But I do think the comparison to the exit of COVID-0 is interesting.
David, I want to end with a final thought from you on that fiscal side. If we are going to be left a little bit disappointed, when is that disappointment going to set in, do you think?
Mainly the size. Well, when we talk about disappointed, actually today, yesterday's policy about the housing market was also some kind of disappointing. Maybe for a foreigner outside China, you would think, oh, China is loosening the home purchase limited restriction, right? You think everything is good. But if you look at what people were expecting, that is more than the actual policy. People were talking about the fully removal of the purchasing restriction in all of the Tier 1 cities.
We're just talking about Guangzhou now, right?
Yes,
yeah.
But it's only Guangzhou removed all. But for Beijing, Shanghai, and Shenzhen, they all kept some of the restrictions. So I think similarly for the fiscal side.
Yeah, maybe a bit of disappointment. All right, David, thank you. David Chu, there, our economist at Bloomberg Economics. Also want to thank Shuli Ren, our Bloomberg opinion columnist as well. We got plenty more ahead. This is Bloomberg. All right, let's talk about AI right now. Nvidia CEO Jensen Huang sees nuclear as a key source to help power the increasing energy demands of data centers. Speaking exclusively with Bloomberg, Huang also discussed how his company is managing customer demands in China against growing chip export tensions with the U.S.
Nuclear is a wonderful way forward as one of the sources of energy, one of the sources of sustainable energy. It won't be the only one. We're going to need energy from all sources and balance the availability and the cost of energy as well as the sustainability over time.
Export controls are a big topic as we go into the November election, particularly when it comes to competition with China. Is Nvidia on track to make a China-safe Blackwell chip?
We haven't announced our future products yet, but the first thing we have to do is comply with whatever policies and regulations that are being imposed, supported fully, and meanwhile do the best we can to compete in the markets that we serve. We have a lot of customers there that depend on us, and we'll do our best to support them.
Do you think the U.S. should back off on China trade sanctions? Do you think the restrictions are effective?
Well, we have to defer all of the policy making to the administration. They understand that the balancing national security versus the prosperity of American technology all over the world. We're exporting American technology, which is really terrific for the United States, that the world is built on Nvidia, on American standards. Nvidia is an American company, and our government and the administration would love to see us succeed. And so finding the right balance is very difficult to do, but they're doing a wonderful job. I'm curious, have you been in touch with either of the campaigns to counsel them on this technology? No, my focus is to build our company, and I trust that they're going to do the best thing for our country.
That was the Nvidia CEO Jensen Huang speaking exclusively with Bloomberg's Styler Kendall, and we're going to stick with Nvidia because Bloomberg has learned Beijing is ramping up pressure on local firms to buy domestic AI chips instead of Nvidia products in a bid to expand its own semiconductor industry and counter US sanctions. Sources say the policy has taken the form of guidance rather than an outright ban to avoid escalating tensions and handicapping startups. Nvidia shares extended declines Friday after the Bloomberg report. And California Governor Gavin Newsom has vetoed what would have become one of the most comprehensive policies governing the safety of AI in the US. The bill to hold AI developers accountable from harm caused by their products drew fierce criticism from some major tech firms who warned it could stall innovation. Newsom says he will consult with experts to develop workable guardrails.
All right, CSI 300 on track for a 9th straight day of gains here. We're heading into that bull market as we wrap up, of course, this working day, and most people heading out to the Golden Week holiday. So certainly consumption still remains to be one of the key sort of beneficiaries of all the stimulus that we've heard in the last week or two. You take a look at how China Tourism Group is doing. We're up 17% or so. So that number, expecting nearly 2 billion domestic trips over the Golden Week holiday. That's what some are anticipating here as well. Property stocks in the back of some of these easing of home restrictions that we got from Guangzhou, removing all of their curbs here. Didn't hear that quite as much from Shenzhen as well as Shanghai, although they did remove some restrictions. But David Chu from Bloomberg Economics says, look, yeah, it might be a bit disappointing that we're not seeing that across the board among some of the tier 1 cities as well. But then again, markets are moving with it. Gemdale prop up some 16% as well. And I think there's more analysts are saying there is still some room to chase this. Aussie miners as well. You take a look at how iron ore is doing here this morning. We're well above, I believe, the 110 level here. Dalian futures are up close to 8% on the back of some of these property measures that we've seen. It markets are really going ahead with this. Rio Tinto, Fortescue, and BHP all rallying here this morning. It's interesting, right? This whole comparison to November of, well, when COVID, those restrictions were lifted. 2022. Yeah. I forgot what year it was already. But you're hearing more sense of this, that the urgency that you're hearing from policymakers, this quick U-turn, it does seem like something like that, the big reopening story.
Yeah, and even Morgan Stanley was saying, okay, maybe this isn't the whatever it takes moment, but it's very close to that moment in time. And I think out of everything we've seen, it really underscores the urgency among policymakers in Beijing. They need to arrest the decline if they've got any chance of meeting that 5% growth target this year.
Heading to that Japanese lunch break, and they're going to need a break here this morning after how they come back from this weekend, given this surprise election result that we got out of that LDP vote, where Shigeru Ishiba is what was picked by the LDP as its next leader. That certainly shocked the market as well, just given his stance when it comes to where they think BOJ and policy should be. He supports, of course, this normalization path as well. That surge in the yen that we saw is paring back just a little bit, but we're still talking about 142 levels for dollar yen. And the Nikkei is certainly feeling it. We're down close to about 2,000 points in Tokyo here this morning. Where we're seeing a lot of that movement is in the lenders and the Japanese banks here this morning, just given what we've been seeing with this movement that, I think Mark Cranfield said it, right? He's been seen as sort of this anti-Abe, Asian NATO backer. What does this mean for market implications and the like? But certainly the banks, at least, are benefiting from this win from Ishiba, given his stance on where rate hikes and policy should be as well, Belle.
Yeah, let's get more on that now. Bringing our Japan economy and government reporter Alistair Gale joining us, along with our Asia equities reporter Winnie Zhu, for more on the implications of Ishiba's victory. And Alistair, we can get started with you because this is someone who's attempted before several times to become the leader of the LDP. I guess you can say 5th time lucky. But what's been the reaction in Japan to this appointment?
Well, I think the thing to remember here is that the election was primarily about the LDP trying to find someone to lead the party that would help them restore public trust. There wasn't, obviously they were discussing policy issues during the campaign period, but one of the main reason really that this election took place is that they had a problem with their current leader, Fumio Kishida, whose approval ratings fell sharply. So they wanted to bring someone in who would help them rebound. And Ishiba is someone who's very popular with the public. So they opted for him. It's really a continuity candidate. He's not said he's going to do a whole lot different in terms of economic policy. And we're expecting him to call an election sometime soon.
Why do you think the market reacted so negatively then to his sort of ascension?
I think really it's a reaction against there was an expectation that the winner of this election was going to be Sanae Takaichi, who's called very aggressively for the BOJ to hold off on rate hikes, is an advocate of fiscal stimulus, and the markets were really positioning themselves for her to come in. And then we had this dramatic conclusion to the election where Ishiba, who was behind in the first round, suddenly zoomed back and got support from lawmakers. And so, you know, here in the newsroom in Tokyo, there were gasps of surprise when the result was called. So it's really the markets kind of resetting themselves in a way for the candidate that they were not expecting to win.
Winnie, I'll bring you in now. This is, as we said, the reaction we're seeing it by investors, this Takaichi speculation being unwound. As we've got a continuity candidate, how do you see trading action faring in, say, toward the end of the week as traders readjust?
Right, so we're seeing a lot of volatility in the market, and today is definitely not a good day for Japanese stocks. Like you mentioned, there's so much unwinding right now because of such a big surprise in terms of the results, but also traders are quite confused to some extent because there is still a lot of unclearness in terms of the direction of both the fiscal and the monetary policy stance of Mr. Ishiba. So earlier, we thought that he would be pretty hawkish. He supports the Bank of Japan's normalization policy. But on Sunday, we hear that tone kind of being tuned down a little bit more. And maybe that's also part of the reason we're seeing less of a big slump in the Japanese market. So traders are really trying to understand where he stands in terms of these policies. But if we assume that he's going to stick with kind of supporting the Bank of Japan doing what they're doing and headed for the rate hike path, we're likely to see banks to continue to enjoy those benefits, and that's actually the bright spot that we're seeing in Japanese stocks overall today. Other areas people mentioned, the defense stocks area is still another key sector that people are watching because Ishiba was the ex-defense the ex-defense minister, and he focuses a lot on improving the military strength of Japan. And another key sector that people really like is the domestic demand-driven sector, including the regional banks, because Ishiba's policy is a lot around revitalizing the rural economy, and those sectors will also benefit from a stronger yen. So on the flip side, they're also adjusting because now that they are pricing in less of a yen weakness, that means selling off the exporters and also real estates if we assume that we're going to see higher rates.
Alistair, as you mentioned, there's that focus now on when we're going to see the lower house election being called. Do we have any sense on the timing of that at Bloomberg? I know there's been local reporting, and also on the sorts of key policy or positions that are likely to be announced as well.
Well, what we're hearing is that there may be an announcement as early as today on the timing of the election. As you say, the Japanese media reports have raised October 27th. As the likely date. So, you know, really what Ishiba is trying to do is sort of capitalize on the good feeling that's around him, the public support level. There's a poll out there from one Japanese newspaper showing that he has over 50% kind of approval ratings, expectations amongst the public that he's going to be a good leader. So he wants to move fairly quickly on this, although he has said that he wants to allow for some debate with the opposition party before the election. So I think we really need to watch that to see how he's going to sort of lay out his priorities. He has said, you know, in comments over the weekend that, you know, he's going to continue the approach of the Kishida administration of trying to beat deflation, trying to raise wages, and to bring, as Winnie said, you know, growth to not just cities like Tokyo and Osaka, but to the rural areas of Japan as well. So I think that's really his policy platform, but we might hear him talk about this in the next few days.
And Winnie, you know, it seems like you're seeing a pretty big divergence in markets here of what Japan and markets like Taiwan are doing today and what China's doing, right? China seems to be setting its own path right now, given all the stimulus measures we've seen. What does the street say now about the momentum that we're seeing around Chinese markets and whether it is sustainable or not?
Right. So, like you mentioned, it's such a big contrast with Japan. That momentum is so strong today, and right now we're seeing the CSI actually headed for a bull market and having its best day since 2015. So, lots of excitement, especially before the public holiday tomorrow. So, people are really rushing into buying more Chinese stocks. And as we talk to traders, most people are saying that this is still mostly a trade instead of a re-rating. And that's also because Chinese stocks right now is very, it has low valuation, it has low weightings among global portfolios. So there's a lot of room for the catch-up. So we might see another leg for Chinese equities rally. But in order to see some fundamental changes or for the rally to stabilize, that would still take a lot more evidence as we see what, if the policies are actually going to follow through. So despite that, it's just so far, because it's so stimulus driven, this rally, most people say that while it might not be this momentum might not last, we can still see a further upside, especially because the government mentioned specifically the support for both the property market and the equity market. So that's why you see today brokerages and also the property sectors are up quite a lot. So it remains a question mark for us how sustainable this rally is. But for the time being, we still see a lot of excitement for this market. And some actually say that there might be some connection between how there's the boom in the Chinese market leading or contributing partly to today's sell-off in Japanese stocks.
Winnie, thank you, Winnie Xu there, Asia equities reporter. Also want to thank Alistair Gale, our Japan economy and government reporter as well. Coming up, we'll take a deep dive into how President Xi Jinping's promise of high-quality development is playing out in the pharma industry. That conversation coming up next. This is Bloomberg.
You're watching The China Show, and President Xi Jinping has repeatedly vowed to make high-quality development a guiding force of the local economy. In today's deep dive, we're focusing on how that's playing out in the pharmaceutical industry and the push to move it up the value chain. Let's bring in Mark Lotter, he's CEO of Nuance Pharma, as well as Jimmy Chung, he's Deputy Director General of Oases, which is a Hong Kong government agency aiming to attract strategic enterprises to the city. Mark, let's start with you, and we can get to Nuance and its business model in a moment, but I do want to set the stage of where or how China has traditionally approached the pharmaceutical industry as a whole, and how it's, again, as we said, looking to move up that value chain.
Right. So, I mean, I think more traditionally it's been very much focused on access. I mean, being able to move from the large cities to more to the west of China. And so that's generally making, drugs available that don't necessarily focus on innovation. I mean, the real pivot now has come both on access plus, the ability to expand on the innovation side. And so you see companies now being, heavily rewarded in terms of focusing on innovation. I mean, that's in terms of the regulatory environment, the reimbursement environment. Likewise, for companies that are purely focused on legacy assets, you see less of attraction for the industry today.
So to put it another way, I guess you're talking about, whereas in the past we've had sort of a focus on the commercialization side, now it's really on the discovery side, innovation instead.
Correct.
And so,
and I think the innovation is designed to service not only the Chinese market, but certainly for companies' ability to go global. So, it's been, publicized over the last year and a bit, multiple deals that have been done, relatively early stage assets that have been, acquired by foreign companies. So I think the innovation is not only purely for China, but also for global interest.
How does Nuance fit into that? Because the approach that you've taken is perhaps a little bit different than to what we've seen traditionally.
Correct. So I mean, we've kind of, I guess, developed somewhat of a hybrid in the sense that we have both a commercial business and we have a development business. So we haven't focused on the R&D side, but rather have captured innovative research in different parts of the world, bringing it back to mainland and then using it to enter the Chinese market and a number of Asia-Pac markets as well. So I think the pivot is really a combination of research and development plus commercial.
The focus you have in terms of the innovation side is more on the respiratory space. Why do you have that?
Yeah, so I mean, I think it's these two factors driving it. I mean, one is just the size of the market. I mean, if you consider the disease burden in terms of respiratory, you have 100 million plus patients with COPD, 50 million plus with asthma, 50 million plus with bronchiectasis, and then the allergy market, which we define under respiratory, is well in excess of 250 million. So there's a big part of the market that is unserviced today. The second is most companies have pivoted in oncology and immunology, whereas we think very specifically for China, looking at respiratory is an attractive space for us to be right now.
Jimmy, I want to bring you in because, as we said, Oases is an organisation focused on attracting so-called strategic enterprises to the city. You approached Nuance, but why?
Yes, the Office for Attracting Strategic Enterprises, Oases in short, was established by the Hong Kong government in December 2022 in order to attract and support strategic enterprises with high potential, representative market leaders coming from 4 specific sectors, including life and health technology, AI, data science, fintech, as well as advanced manufacturing and new energy technology. And we provide such strategic enterprises one-stop and tailor-made services to facilitate their setting up and expanding in Hong Kong. And some typical services we offer for strategic enterprises may include provision of market information to facilitate their feasibility study, introduction to technology parks to support their searching for a suitable business premise, facilitations on work visas, government fundings, and so on and so forth. So we have offered quite a lot of these services to Nuance in the past. And of course, Nuance being a biomedical company with cutting-edge technology is definitely one of our target customers, clients that Oasis would like to bring to Hong Kong.
You're looking at a listing here in Hong Kong.
Correct.
What would be the timeline around that, and why would you choose Hong Kong over other markets like Singapore, for instance, where we do have a strong manufacturing base and a strong government policy program in place as well?
Yeah, I mean, from a timing point of view, we would target 2026 principally, so using 2025, sorry, using our 24 results as a timeline. I think for us, Hong Kong is a lot closer to home. We believe there's a lot of synergies between Hong Kong and the mainland market. We think the support that we will get both in Hong Kong and the mainland will be supportive of a listing. And I think we have the benefit of looking at, both the main board listing as well as going for Section 18A. So for us right now, we're pretty much focused on Hong Kong as a target.
Jimmy, the IPO pipeline hasn't really recovered in Hong Kong just yet. There's signals that we might have a number of listings coming to the city, and we hear that there's a number of companies that are waiting on the sidelines. But what are the top concerns that you're hearing?
Well, totally understood. The IPO market has not been doing great recently, but we have also seen some positive developments in the stock market, both trading volume and prices going up together recently, and hopefully that will provide greater confidence for potential companies to get listed here. And according to the latest Global Financial Centers Index, Hong Kong once again has been the world's number 3 and Asia's number 1 financial hub, and that really sends a strong signal that Hong Kong's status as an international financial center remains very robust. So I guess Nuance's plan for getting listed in Hong Kong in 2026 is well-grounded, and Oases will do our very best to support that initiative.
I do need to ask, though, amongst, yes, of course, that was a big story for Hong Kong returning or beating Singapore in those financial rankings. But one of the most read stories today on the terminal so far is a number of assets that are basically at fire sale prices in Hong Kong, and still the business environment is weak here. So where do you think we would be at in terms of a recovery?
Well, I think the Hong Kong government is very committed to continuously improving our business environment. We are leaving no stone unturned in achieving that objective. And in particular, when it comes to innovation and technology, we're deeply committed to developing Hong Kong into an international I&T center. In fact, it has already invested more than 200 billion Hong Kong dollars in the past 10 years in this regard. And one of the many related initiatives is the setting up of the Oases in December 2022 to support strategic companies, and also a 30 billion Hong Kong dollar co-investment fund to also support that very important objective. We are very confident about the Hong Kong's future economic prospects.
Okay, Jimmy, that was Jimmy Chung there, Deputy Director General of Oasis, as well as Mark Lotter, CEO of Nuance Pharma. Thanks very much for both of your insights here this morning. And you can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter. That's out every single Thursday. You can sign up via bloomberg.com/newsletters. We'll have more ahead. This is Bloomberg.
Here's your China brief. A look at what's making headlines in the national media today. And the China Securities Journal has launched a series of articles on efforts to boost stocks, saying it's key to building confidence in the economy. Part 1 on today's front page plays up the equity rally following that wave of stimulus, and it says the policies will continue to have an impact as government departments step up coordination. In another front page piece, I should say, the paper says local investors are rushing back into A shares. It cites data from state-owned lender ICBC showing a recent increase in fund transfers from bank accounts to the securities market. And Shanghai Securities News is flagging the possibility of more fiscal policies to support the economy. It cites experts who say fiscal spending should be expanded to stimulate demand. They also recommend speeding up the issuance of special bonds and relaxing the scope for their use.
Yeah, and on social media, Weibo as well, it's really that focus we're seeing on those sorts of home buying easing policies that were announced over the weekend. So this is the focus really being led by Guangzhou, because we saw them lifting all home buying restrictions. That is among the top 10 trending topics on Weibo, generating more than 4 million views and almost 10,000 comments. And we know, of course, that October is, seasonality-wise, one of the big periods for home buying in China. Is this a case of JIC? Just in time? That's what I wanted to say.
I didn't know that
But JIC doesn't make sense.
No, but most of the comments are upbeat, right? So are people going to be rushing during this Golden Week holiday to go buy up property? Some say, look, good news. I hope the housing market will turn around soon. Someone else said Guangzhou is pioneer. Other cities will follow, and hopefully real estate stocks will rally from here. Another user saying, let's welcome people around the country to come to Guangzhou for shopping and tourism. And of course, home buying too. We're certainly seeing a lot of that in Guangzhou of late. A lot of people for tourism. And take a look at this. This is one of our favorite posts that we've seen. We were talking about this with Angela Hanley just earlier. A little bit more of a lighthearted post, right? It's been widely shared, though, in China, right? They started to talk about the days that we saw that stimulus, right? So I think it was September 23rd.
Yeah.
It's like, let's stay home. Let's not do anything during this Golden Week holiday. You take a look at that a day later, we start to get more signs of stimulus. Maybe we can go out to the city and walk around. The next day, before summer ends, maybe let's go to Sanya's, keep it domestic. Let's not go, anywhere too far. And then you see by the end of the week, yeah, let's just go straight to Europe. I won't even go to Japan.
Exactly, and that's what we're seeing.
To me.
You know, these numbers are looking better, and that's the big expectation. Are we going to see that sustained lift coming through in the Golden Week holiday spending? I mean, you take a look at the signals we've got, and Macau bookings, for instance, are looking strong. We're seeing this expectation around trips, and something else Angela said as well, that the spending per customer is expected to pick up, and that's a very, very important signal as well for the market.